Three stocks that have taken quite a hit today. On today's episode, we are going to take a look at Vroom. The stock is down about 11.46% today. We're going to take a look at car parts, down 6.3%. And we're also going to take a quick look at Hims and Hers, which is down 6.4%. Like always, we're going to take a quick look at future growth, fundamentals, recent news, technicals, and even valuation metrics to see how the stocks are looking right now. So let's get started. So the first company we are going to take a look at is Vroom. This is an online marketplace for your vehicles. You can buy, sell, trade your car. You can even do forms of financing through Vroom. Here you can go to their website and pretty much see what they offer. Vroom right now is traded under the Nasdaq as ticker VRM. It's currently down, like I mentioned, 11.46% today. It is sitting at about $40. From its 52-week high, the stock has definitely seen quite a correction. It's down about 45.84%, and it currently has a market cap of $5.46 billion. Taking a quick look at future growth, Vroom is expected to grow 39.3% on average for the next 3 to 5 years, so this is a hyper-growth stock. If we take a quick look at fundamentals, the company is not profitable. They're not positive in cash flow from operations. Normally, this is what you see with a very high-growth stock like Vroom is. But now we have to be very, very strict on their balance sheet. If we take a quick look at their balance sheet, the company right now has about $940 million in cash and short-term investments and about $253 million in debt. So they have a lot more cash than debt. They're positive in net cash, which is a great thing. But to be honest, I would prefer if this company had no debt whatsoever. When a company is not profitable or positive in cash flow like we saw, the less debt, the better. Before we take a quick look at recent news and why the stock price is down, make sure to hit the thumbs up and the subscribe button if I am providing some form of value to you guys. And let's take a quick listen to today's sponsor, a great reason why I'm able to provide so much content to you guys for free. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services the Fool offers. Through the Motley Fool Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the Stock Advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. On June 14th of 2021, Vroom announces a proposed convertible senior notes offering, and I do believe this is the main reason the stock price is down. They are expected to raise about $500 million, and this convertible senior notes are not due till 2026. So they're building up a nice cash position. Obviously, they're going to build up a debt with it. So Vroom intends to use the net proceeds from offerings for general corporate purposes, advertisement, marketing, expansion in logistic operations, just overall increased technology development. They also might use portions for some form of acquisition or investment in the business. At the moment, they do mention that they have no commitments or agreement to acquisitions or investments at the time. If we take a quick look at their most recent earnings, which they presented May 12th of 2021 for the end of the March 31st quarter, they had about 15,500 e-commerce units sold, which was up 96% compared to the same time last year. It is important to remember, right, same time last year, we were kind of having some form of COVID impact. So just kind of understand where the market was same time last year. E-commerce revenue was $422 million, and that is up 81% compared to the same time last year. So we're still seeing huge growth for the company. Some other things worth mentioning: for the full year of 2021, they continue to expect triple-digit year-over-year growth in the e-commerce unit sales and more than 200% year-over-year growth in aggregated gross profit. For the second quarter, they expect about 17.5 to 18,000 e-commerce units being sold. That represents 164% growth compared to same time last year. Again, remember, COVID was really affecting especially the second and third quarter here in the United States. The average e-commerce selling price per unit is somewhere between $27,000 and $28,000. So it's not like they're selling super cheap cars, right? That's a typical sedan price at those levels. So they definitely have some nice vehicles, it seems. The average e-commerce gross profit per unit is about $2,500 to $2,600. So continuing here in the car market, the second company I want to take a look at is carparts.com. This is pretty much an online e-commerce store for your car parts. Right now, it's traded under the NASDAQ as ticker PRTS. It's currently sitting at $17.39, and it ended the day 6.3% down. It currently has a market cap of $836 million. So this is a very, very small company. And if we take a look from its 52-week high closing, the stock price has seen quite a correction, 20.48%. If we take a look, this company is expected to grow 15.3% on average for the next 2 to 5 years. So unfortunately, taking a look at trailing 12 months, the company is not profitable. They're not positive in cash flow from operations. But within the next 12 months, they are expected to reach positive cash flow from operations. So that's some good news. If we take a look at their balance sheet looks pretty strong. About $46 million in cash and short-term investments, no debt to their name, and also a high position of inventory. So that inventory will eventually turn to cash or some form of cash flow. I do enjoy their balance sheet right now. They have strong growth. And they are soon to be positive in cash flow from operations. There hasn't really been any recent news that could kind of determine this stock price droppage right now. It could just be the overall growth market kind of seeing a bit of a slowdown right now. But if we take a look at their most recent earnings, which they presented May 10th of 2021, they recorded 65% year-over-year revenue growth. This is also their 5th consecutive quarter of year-over-year sales growth. They reaffirmed their long-term goal of 20 to 25 compounded sales growth for the future. So we can see this is definitely a growth machine in a pretty interesting market. Right now, Car Parts is in active discussion to expand the Texas distribution center by 156,000 square feet. This expansion in the distribution center will obviously increase their revenue capacity and will allow them to meet the exponential growth in demand that they are seeing from the customers. So we can see this is definitely a company that's also seeing some impressive growth. All right, so the final company we are going to take a look at is Hims and Hers. This was very popular when they IPO'd, and ever since, I want to say it's kind of taken a step back. This has 2 businesses within the company. The first one and the one most people understand is the overall e-commerce platform, where you can buy either health products, supplements to hair losses, COVID situation, skin, mental health, or other type of supplements. They also have a telemedicine platform where if you want to get prescribed certain medicines for those types of conditions, you can also use their telemedicine platform to talk to a professional and get prescribed certain medicines and then go back to their e-commerce platform to purchase it. So Hims and Hers is traded under the New York Stock Exchange as ticker HIMS. It ended the day about 6.43% down. And we can see right now the company is sitting at a small market cap of $2.2 billion. The 3 companies I mentioned today are definitely some small players in the game, but are definitely in interesting markets. We can see from its all 52-week high closing, the stock is down 50.65%. Hims is expected to grow its revenue 22.5% on average for the next 2 to 5 years. So this is a nice hyper growth stock. Unfortunately, the company is not profitable. They're not positive in cash flow from operations. So again, this is not a bad thing, just an added risk to the back of my mind. And then it also makes me a little bit more strict on their financial health. Financially, they have about $323 million in cash and short-term investments and no debt to their name. So again, this is a strong balance sheet, and obviously a balance sheet like this is needed for a company with the fundamentals we saw right now. Some recent news: on June 14th of 2021, Hims told their investors that they are trying to expand their UK footprint, and they're going to do this by acquiring a London-based Honest Health company. And this Honest Health offers consumers with products like hair loss related products. We can see that's already a market Hims and Hers is doing. So I do believe it was a great move, and a move that allows them, like they say, to expand into this market. The main reason I believe the stock price could be down is there isn't any financial details of the transaction, and that will not be disclosed at the time. And normally when you kind of announce an acquisition, you kind of say, hey, it's going to be some form of cash position, mixture of stock, and we're paying this much. Some other recent news: on June 9th of 2021, Miley Cyrus did join Hims and Hers as a creative advisor. Obviously, I don't know Miley Cyrus or her business background, but I do believe as a content as a creator advisor just because of the huge backing she has. It is a smart move for the team and good publicity stunt as well. If we take a look at their most recent earnings, Q1 2021 revenues grew 74% compared to the same time last year. Their gross margins were 77%, and they even exceeded their Q1 2021 guidance that they had to raise their full year guidance as well. So strong growth. This is a company that even with the high guidance that they gave, they're still expecting more. They are ending the quarter with about 391 subscriptions on their platform, and this is up nearly 80% compared to the same time last year. Some good things I want to mention about this company. Again, none of these are in my portfolio, but I like to learn about companies. The average order volume has increased every quarter. Right now it's about $74 per order, where same time last year was about $52, and last quarter, which was during Christmas time, was only $69. Net orders are also increasing, and their online revenue is up dramatically every quarter and makes up a good portion of this company's total revenue. Now let's take a quick look at technicals. I just want to make sure the stocks are not overextended at the moment. All right, so first let's start off with Vroom. The stock price right now is definitely not overextended from its moving averages, and there is a nice volume area here around the 35 levels. If we take a look at card parts a bit overextended prior to the drop. I do want to say it's still a little bit overextended. That doesn't deter me. It's just, hey, add it to the back of my mind. But there is plenty of volume around here. The final company was HIMS, right? And HIMS definitely not overextended either. Definitely sitting at great volumes area. Obviously, all these stock prices can continue to go down. I just do believe a good portion of the risk has been eliminated. Now, if we take a quick look at valuation metrics for all three companies, since they are growth machines, I want to take a look at price to sales ratio. Vroom right now has 1.3 forward price to sales ratio. This is what I want to say probably on average of where it's normally been. So I wouldn't say it's overvalued or undervalued compared to where it's been in the past. I want to say it's somewhere in the middle. Card parts is right now 1.345 forward price to sales ratio. Very similar. I want to say maybe it's a little bit on its high end compared to where it's been in the past. So investors should keep that in the back of their mind. Finally, we have HIMS and HERS. Forward price to sales ratio is about 8.4%. Again, this one is a lot higher than Vroom because it's a different market, different types of gross margins as well. This is actually a bit cheaper than when it's been historically. Again, stock prices can continue to drop, and this is not a guaranteed, but I believe a good portion of the risk has been eliminated. Now, my overall thoughts. All three companies seem pretty strong in form of growth. They're all, I want to say, in very early stages of their business. If any of them were to enter in my portfolio, I think at most they would be a tier 3 stock. So now in form of my favorites, I think Card Parts and HIMS would have a tie. Even though they're in both different markets, they're both seeing strong growth like we saw, and expanding. We saw Card Parts expanding into different markets. So I hope you guys enjoyed today's episode. Like always, take care. See you next time, and peace out.